Mortgage rates, they are now at their lowest level in months, and if you're one of the many high credit borrowers who might have taken out a large or an exotic loan during the housing bubble, is now the time perhaps to think about refinancing, and if so, why? And how do you do it? Answers from CNBC's On the Money host, Carmen Wong-Ulrich. Nice to have you back, Carmen.
Hi, Sue.
Pleasure.
Hi, guys. Thanks.
Let's talk about when you decide to do this. What should be the tipping point when you look at your house, your mortgage, and say, you know what, now's the time?
You know, a lot of it just has to do with crunching your own numbers, and these numbers can be huge. You look at the interest rate you have now, even on jumbos, they're really heading down. So we're talking about, let's say you have an $800,000 loan, right? If you have 7.5, if you can get and refinance to a 6.5, which is actually within the realm of possibility these days, we're talking about saving $200,000 over the life of a 30-year fixed mortgage. That's not chump change.
No, it's not. The question that a lot of people have, though, is even if you do have a good credit score, we're still hearing that credit is tight.
It is tight. Here's the key. The secret, the access is all about equity. Okay, so if your credit is good, it's not just about your credit anymore. It's about the equity that you have. If you're talking about refinancing, listen, lenders are going to still be very, very shy about lending to you if you do not have at least 20% or more of the value of your home in equity. They don't want to have anything to do with you.
Carmen, thank you very much.
Thanks,
Appreciate it. We'll see you tonight. A special edition of On the Money, improving your financial health right here on CNBC at 8 p.m. Eastern Time. We'll be watching, Carmen.
Meantime, let's go to Diana Olick in Washington and look at how the bailouts or the seizure, if you will, of Fannie and Freddie by the government has affected mortgage rates and how borrowers and lenders have been responding so far this week. Diana?
Well, Bill, as soon as the government announced its takeover of Fannie and Freddie and said that the Treasury would begin buying new loans to the tune of $5 billion, suddenly mortgage rates went down and talk turned to a refi boom. But so far, days later, we're just not getting the calls.
We're not seeing necessarily phones ring off the hook in that it doesn't seem as if consumers are yet aware that rates have come down enough where it might make sense for a lot of them to consider refinancing.
Now, according to Bankrate.com, the overnight rate on the 30-year fixed is down to 5.79% from 6.19% a week ago. But for many, there are big barriers to refi. For one, home prices are down nationally 18% from their peak in the boom. So while they haven't given up all the gains, depending on when people bought their homes, many Americans owe more than their homes are currently worth, making refinancing too costly. Now, one study from Zillow.com claims that 1/3 of people who bought their homes since 2003 now have negative equity. And then, of course, there's the issue of lending standards.
You're going to need a better credit score, more equity, and excellent documentation of your income to qualify.
Now, of course, for those who do have good credit, now could present an excellent opportunity to get into a new loan, especially if you're in that sort of conforming jumbo range, that is the temporary range that went to $729,000 that will now change to $625,000 come the first of the year. So if you do have the good credit and the money to put down, you should look into it. For more, go to the blog realtycheck.cnbc.com. Sue and Bill?
So it's too simplistic just to look at the drop in the average 30-year fixed rate and anticipate a bunch of people coming in to refinance. There are too many other situations that they have to face before they make that decision.
Right, exactly, because credit was really just one piece of the puzzle in this. You have to look at home prices. It's a much bigger issue for people in their homes, depending on when they bought, because if you have very little equity, no equity, if you've got one of these loans where you put no money down, then what are you going to refinance to? So you got to look at your market, you've got to look at what you have in your home, and the rate just doesn't matter at that point.
Diana Olick, thank you very much.